May 6, 2010 began like any other trading day on Wall Street. Investors were watching Europe's debt crisis unfold, but markets were functioning normally. By mid-afternoon, however, the unthinkable happened. In a matter of minutes, the US stock market collapsed by nearly 1,000 points, the largest intraday drop in history at that time, only to rebound just as quickly. The event became known as the flash crash, and it shook confidence in the stability of financial markets worldwide. The roots of the flash crash lay in how Wall Street itself had evolved. By 2010, trading was no longer dominated by humans shouting orders on the floor of the New York Stock Exchange. Instead, high-frequency trading firms and algorithms executed thousands of trades per second, competing on speed measured in microseconds. These systems could spot price changes and react faster than any human could hope to. This technological arms race had created new efficiency but also new fragility. On the day of the crash, the trigger was a large trade by a mutual fund seeking to sell $4.1 billion worth of futures contracts tied to the S&P 500. Normally, such trades would be carefully broken up and executed slowly. Instead, the algorithm used executed the order too quickly, flooding the market with sell orders. High-frequency traders picked up on the pressure and began aggressively selling as well, adding fuel to the fire. Within minutes, liquidity, the ability to buy and sell without massive price swings, evaporated. Stocks of some of the world's largest companies plunged to pennies a share. Shares of Procter & Gamble briefly traded at just 1 cent before snapping back. Other blue-chip stocks saw swings of 50% or more in seconds. Exchange-traded funds, ETFs, that were supposed to track baskets of stocks completely broke down. For traders watching live, the event was surreal. The Dow Jones Industrial Average dropped nearly 1,000 points in less than 10 minutes, erasing almost $1 trillion in market value. Panic spread as screens flashed red. Many feared another financial crisis was unfolding in real time. But just as quickly, the market rebounded. Within 20 minutes, most of the losses had been erased. The aftermath left regulators scrambling for answers. How could the world's most advanced financial system suffer such a dramatic breakdown without warning? The Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, conducted a joint investigation. Their conclusion was that no single trader or institution had deliberately caused the crash, but rather that the interaction of algorithms, high-frequency traders, and a single unusually large order had combined to create a cascade of selling. The flash crash highlighted the risks of automation and speed in financial markets. While algorithms brought efficiency, they also created complexity that even their designers didn't fully understand. In response, regulators introduced new safeguards. One was the creation of circuit breakers, automatic halts in trading if a stock price moves too far too fast. Another was enhanced oversight of high-frequency trading strategies. The event also shook investor psychology. Retail traders and professionals alike were reminded that technology could amplify volatility in unpredictable ways. Some feared that markets had become too fast, too automated, and too fragile for human investors to trust. Others argued that the rebound proved the resilience of the system. Over a decade later, the flash crash still serves as a cautionary tale. It revealed that Wall Street's infrastructure, while advanced, was vulnerable to feedback loops and runaway algorithms. The idea that trillions could disappear and reappear in minutes raised profound questions about market fairness and stability. For long-term investors, the lesson was sobering. No matter how carefully you analyze fundamentals, sudden shocks can strike without warning in the age of automation. For regulators, it was a wake-up call to ensure that technological innovation does not outpace risk management. And for traders, it was proof that in modern markets, milliseconds can make the difference between fortune and disaster. The flash crash remains etched in Wall Street's memory as the day the market fell apart and stitched itself back together in minutes, a powerful reminder of the thin line between order and chaos in financial markets.